Stock options are not always the answer. In fact, in some situations, they make it almost impossible to make money. Today, we're going to take a look at GameStop. It is a stock that almost everyone is familiar with. I'll show you a big move that just happened and show you why in this situation, options, even though you were right on the move, did not result in any profits. I'm going to show you how to avoid getting in these situations that are rigged against you and prevent you from profiting even when you're right. So let's go to the chart. Now, this is GameStop, a stock everyone is familiar with. The thing started around $10 back in late 2020 in a Reddit-inspired short squeeze. The stock ran from $10 to $480, fell all the way back down to the 40s on some sketchy behavior from the brokerage houses, but is now making a second run, pushed up here to $350, back down to $150. It's all over the place. It's extremely volatile. And look, I'll be honest, there's a lot of money to be made in these swings. But as I mentioned, there are situations where even when you're right, you won't make any money. Let's dive into this chart a little bit deeper. I'll go into a 30-minute chart so you can see what happened overnight. So take a look at this. The stock closed on Tuesday at $181 per share, gapped way down on bad earnings, and is currently trading around $145 a share. So about a drop of, call it $35 a share. And I'll get an exact number here. We'll put a measurement tool on here, and what do we have? Yeah, 20% drop, $35 per share, okay? Now, let me bring up an option chain to show you why options would not have been the answer if you were betting short on GameStop. Now, this is an option chain for GameStop, for GME. If you've never traded options before, don't let this thing overwhelm you and all the numbers give you a seizure, okay? I'll break it down for you. It's much simpler than you think. Up here in the top left, we have the symbol of the stock, GME. Each of these the yellow text, each of these headings is an expiration time. We're going to look at the monthly April options. They expire on the 16th of April in 23 days, okay? Each of these down the middle is a strike price, the execution. The calls are on the left. In other words, bets that the stock's going to go higher. The puts are on the right, which are bets are going to go lower. Now, in the last 24 hours, we just looked at GameStop. It's down 20%. The stock fell $35 a share. So let's say before earnings yesterday, you said, you know what? I think GameStop's too high. It's going to go down. I'm going to buy a put option on that stock. Okay, so it's trading 180. Here's the $180 put. You see it's trading for $60 a share, 60.35 by 61.85. That's just the bid and the ask. So just take the average of those two, right? Around $61. Well, this column over here on the right side, let me see if I can stretch that out a little bit, is the net change. In other words, how much the price of that option has changed in the last 24 hours. And look what you see there. That 180, it's at $61. It's only up $6. So the option, you bet the stock was going to go down. It fell 20% or $35 a share, and you made $6 a share on that put option, or 10%. So by using a leveraged product like an option, you made half of what the stock moved in. It just doesn't make any sense. However, let's look at the other side of this coin. Let's look at the call options. Now, that same $180 call option, see it trading for $26, $27. It fell, its net change, it fell $26. So it fell by 50% when his stock fell 20%. That's what you would expect. So you're saying, Ross, the calls came down like you'd think would happen because the bet the stock's going to go higher, yet it went down, but the puts didn't go up very much. So why is that? What's the secret there? How come the people who made the right bet, who put their money into put options, betting stock would go lower, it happened, but they didn't make any money? What's the secret? Well, I'll tell you. It's this little number right up here. See it at 280.95%? That is what's known as the implied volatility. And also in parentheses, you'll see plus or minus 101.144. What that is the market maker's estimate of how much that stock is going to move by the expiration time. So these expires, we mentioned, April 16th, 23 days from now. The market is pricing in a $101 move up or down in the stock. That's huge. So the implied volatility is 280%. It's an astronomically high number. If you haven't traded a lot of options, normally an implied volatility of a non-high volatility stock like a Walmart or a Coca-Cola or something is going to be 18%, 20%, maybe 30, 35% if it's starting to move. 280% is astronomical. So what happens is the price of those options, because we just got this big move, it was volatile on Tuesday. It's even more volatile on Wednesday. So because of that, the price of all the options has increased, puts and calls. So even though the stock has come down, you didn't make 10% on a 20% drop. You got screwed, okay? And this is why, the implied volatility. Anytime the implied volatility is up, I'll say over 80, 90%, when you get into 100, 150, 200, in this case, 300% implied volatility, anytime you buy options, it is almost impossible to make money unless the move is completely astronomical. When this implied volatility, you'll see it abbreviated as IV, this little percentage number up here next to the expiration month. When that number is over 100%, I generally do not like buying options for this exact reason. Generally, in these situations, you want to be a seller of options. Now, there are limitations to the average trader's ability to do this. For example, selling call options has unlimited risk. You're selling someone the right to call the stock away from you at a given price. So the stock could go from 150 to 350 to 1,050 and have a Tesla-esque run, and you have unlimited risk to how high it could go. So unless you have extremely high option clearance, most brokers will not allow you to sell those calls. On the other side, if you think the stock's going to go up and you want to sell puts, you can do that. You don't have unlimited risk, but you need to have the money in your account to buy the stock. So that's today's lesson on options. It involves implied volatility, why this number is so important, why it can prevent you from making money even when you're right. And my kind of line in the sand general rule, when that implied volatility is call it 80% or more, I generally do not like buying options unless you're just trying to play something very, very, very short term. So watch the implied volatility, keep that number in mind, and don't get yourself in a situation where it's almost impossible to make money. Now, I run a trade alert service called Precision Volume Alerts, where we identify stocks making large moves and use a secret volume roadmap to pinpoint both buy and sell targets using that. On the chart here of GameStop, you'll see high volume areas that tend to be magnets for a given stock. So in a case of GameStop, that level would be about $120 per share. So if I was trying to get short GameStop, or bet it's going to go lower, that would be my target. And in fact, on this move, that's where I would look for the stock to go next, is right here around $120 per share. We also use options to capitalize on these moves by modeling trades designed to achieve the highest possible percentage return. Now, obviously, there are situations just like this one with GameStop where these are just not viable trades with options because of all the things we've just covered. But most of the time, that's not the case, and we're able to use options to achieve 200, 300, 500% plus returns on stock moves that are much, much, much lower. So if you want to learn more about this, click the link below this video. I've got some on-demand training where I'll show you this entire methodology and help you to identify both stocks that are on the move and how to pinpoint precise entries and exits.